Just inches away from all-time highs. 30 minutes until the start of your cash equity trade. I'm Dani Burger.
And I'm Michael McKee. Bloomberg Open Interest starts right now.
Coming up, another record in sight for the S&P 500 as a packed earnings slate tests the rally. Speaking of which, SpaceX steps into the earnings spotlight while otherworldly demand powers Palantir. And oil gives up its gains as hopes rise for a diplomatic breakthrough between the U.S. and Iran. Some of the stocks that we're watching this morning, it is about earnings and the AI trade. It's front and center after Palantir reported their earnings. Just such strong results from them. It's their enterprise sales that really picked up and showed, yes, AI spending is translating into meaningful revenue. Meanwhile, today, we're going to hear from SpaceX that will deliver its first earnings report. Shares, though, are down 15% since its IPO. Wall Street is going to start to shift its focus from growth to margins and cash flow. Let's discuss that with Bloomberg Tech host Ed Ludlow. And Ed, this is a company that's had a fall for grace since it IPO'd. What are the stakes today?
On SpaceX, everyone's seeing this as the event of the summer. There is some doubt about the set of consensus estimates for the numbers that have been put together. But essentially, the story's highly analogous with what we've seen in the tech earnings season so far, that people will look at what SpaceX plans to spend from a capital expenditure standpoint. The expectation is they'll say it will be north of $45 billion for the year. And in this kind of interim period where the launch business is still important, Starlink is the cash cow, and the AI business is very distant, they'll start to look at what the sort of cash burn is on that AI business. What I mean by that is, since SpaceX acquired xAI and has merged and integrated it in as SpaceX AI, what kind of a financial burden is that on the balance sheet? That's probably where there'll be a lot of focus in the short term.
What about tomorrow, or Thursday, rather? I guess I'm getting ahead of myself here, when the stock market when the stock is unlocked?
Yeah, the lockup period's really important. So August 6th, 911 million shares come online. Compare that to the post-November earnings period, more than 1 billion shares come online. And I think the streets had a really hard time because it's an unusual lockup period. A lockup period, a restriction where insiders, those high up the cap table prior to it going public, can't sell shares. The stock's under pressure, right? $1 trillion of value has been wiped from the post-IPO peak. But remember the commentary and the days around the IPO, all of these great venture capital firms and mutual funds saying, yeah, we won't sell our shares, we'll hold on to them forever, or redistribute the shares to the LPs and they'll hold on to them forever. So it is difficult to say for certain, Mike, what will happen.
Well, this isn't Polymarket, but go ahead and give me a bet here on which moves the stock more, the earnings report or the lockup.
For me, and I wrote about this in Tech in Depth on Monday, I think it's whether the question on a Tesla merger gets posed somehow. Because if you remember what happened in Tesla's last earnings, a very brave sell-side analyst asked Elon Musk the question, are you going to merge Tesla with SpaceX? Maybe that happens again tonight. There's also a mechanism for retail shareholders to ask questions to SpaceX just as there is with Tesla. But the lockup period going forward, it is going to be a big factor. And again, the reason that there's such doubt on the consensus numbers for tonight is because everything that SpaceX presented around the IPO is based many years into the future, right? And it's hard to model for that.
Same with Tesla, right? Same problem with them both looking at things that will only pay off in the future. Ed, thank you so much. Looking forward to Bloomberg Tech, 11 a.m. That's Bloomberg Tech host Ed Ludlow. Elsewhere in earnings, pharma giants Merck and Pfizer both reporting earnings before the bell. Newer drugs help lift Merck's forecast, while strong demand for older drugs prompted Pfizer to raise its guidance. Joining us now is Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli. Sam, is it a problem for Pfizer? What really is winning out for them is their older pipeline, not newer things like we saw from Merck?
Yeah, sure. So, Dani, if you think about it, these are two pretty similar companies in terms of their trajectory of revenues. They're both facing patent expiries. We can discuss the nuances of is it easier for generics to compete, which of course it is, with a small molecule like Eliquis for Pfizer or like Ibrance for Pfizer versus a biologic for Keytruda for Merck. We can discuss all that. Our patent team have got different views on this, but at the end of the day, once we've got in the helicopter and gone up and had a look down, they look very similar. patent expiry is coming. So therefore, what's important is how you're going to manage that with your pipeline. And clearly, Merck, given its share price performance, not just today, look at the past few weeks and few months, etc., have managed to convince people that they have what it takes to deal with this patent pressure, which is huge. Look at the size of Keytruda, over $8 billion of sales this quarter, versus what Pfizer has been doing.
Well, what is Pfizer saying about how they're going to deal with that problem?
Well, so they're doing what, I mean, obviously they've done some acquisitions, so has Merck. One of the biggest one they did recently, and that's Pfizer, is where they got this very powerful drug, Padcev, for a variety of diseases, but specifically very successful in bladder cancer in the acquisition of Seattle Genetics, or Seagen. And that was a pretty big acquisition. The thing is that you need more than just one drug added to the pipeline to do that. And what Pfizer is doing is the normal reaction to this upcoming pressure, and that's cost cutting. They've added another $2.5 billion to the number they had before, taking us up to $9.7 billion of cost savings. And that's a big number, right? By 2029, 2030 timeframe.
But at the same time, they are losing their CFO to Nike, David Denton. He has been viewed as a calming force, a financial steward. Sam, is it a blow to Pfizer to lose Denton?
It's always a blow when you lose somebody who's been at the helm of a company that's gone through very difficult times and very great times. Imagine these guys were doing 50, 70, 80 billion dollars of revenue from COVID vaccine for a while, managing that cash flow, etc., and then manufacturing. So, and going through this cost saving, of course, they have a new CFO and that would be something that is, to a degree, textbook for a pharma company that's dealing with a major patent expiry.
Sam, really great to get your thoughts this morning. That's Bloomberg Intelligence's Sam Fuseli. Now, wrapping up this morning's earnings, McDonald's named Sky Anderson as president of its U.S. business after posting its slowest growth in over a year. Joining us now is Bloomberg consumer reporter Red Brown. Red, are these two things related? Is this a McDonald's that needs to do something to revamp its U.S. business?
Yeah, I mean, I guess it's tough not to say they're related, just given the timing of the results as they were. You know, the weakest in over a year for the U.S. business, which is so critical to McDonald's, and then the timing with the replacement. So, you know, I don't have any kind of inside knowledge into what's led to that decision, but it's tough not to draw the line between these two events. What's interesting to me in the U.S. and maybe what's kind of going on with this change is, you know, we saw that the sales growth that they did have, which was very low, was driven by higher ticket price rather than foot traffic, where a lot of the strategy has been to drive traffic, right? The lower menu price items were to get people in the stores, and now we're seeing that sort of shift. So I'm wondering, too, if kind of what's going on with that strategy, if that's sort of maybe underlying maybe a rethink of what's going on in the U.S.
Well, of course, McDonald's was the poster child for the K-shaped economy, and it does suggest then that they're seeing problems with the lower income customers, and yet at the same time, price pressures for their ingredients.
Yeah, absolutely. And it's interesting, it just came across the wire, the company saying that their under $3 menu is underwhelming their expectations. So that is interesting that lower kind of prong of the K-shaped economy is maybe where some of that weakness is starting to develop. It's also kind of interesting that they've been pushing into sort of higher quality menu items as well. So maybe an attempt to sort of address the upper end of the economy as well. Can we make this more of a family restaurant again? They're remodeling some stores, trying to get this into a regular sort of occasion for people to come spend time there. So they obviously are still doing things, probably picking up a lot of the things that we're talking about as well and seeing what they can do.
Interesting that whole idea of lowering your prices isn't necessarily the thing that's working for them. Red, thank you so much for joining. That's Bloomberg's Red Brown. Now, let's get a check on markets this morning because we are looking at all-time highs, at least in the future session. We need to get to 79.06. 76.09, rather, my dyslexia this morning, in order for the S&P to get at another all-time high. Futures already there, we're up 1/3%. The Nasdaq outperforms this morning as the Mag 7 posts its largest daily gain yesterday since the end of March. 10-year yields come down, aided by the price of Brent crude. That's down 2.6%. We'll have your Iran update with Jeff Mason in just a few moments. First, though, let's get a look at your movers. And what's moving the market this morning with that is Nora Melinda. Hey, Nora.
Hey, Dani. 3 stocks in focus this morning. Looking looking at shares of Caterpillar jumping double digits in the pre-market trade. Now, that's after the company beat on profit and revenue. But here's what's standing out here. We are seeing demand tied to AI data centers, helping make up for weaker spending elsewhere. So yet another sign that the AI build-out is still going strong. Now from here over to streaming, I'm looking at shares of Spotify under pressure, down 6% in the pre-market. This is after its outlook disappointed investors. The company now has more than 300 million paying subscribers. I am one of them. But Wall Street wants to see its AI features and its ticketing business actually translate into more growth. And finally, over to Nike, we're seeing shares sinking, down about 3.4%. This is after a downgrade from JP Morgan. JP Morgan saying that Nike's win now strategy may help the brand eventually, but it's going to come at a cost in the meantime. Those are your morning movers. Dani?
Nora, thank you very much. Nike also posting a tough stretch in their latest earnings. Coming up on the show, the prospect of a deal between the U.S. and Iran appears to be gaining traction. We'll get you the latest. That's after this break. Let's get you some high-interest stories. A look at what's making headlines around the world. Anthropic is locking in more AI horsepower. The cloud maker signed a $10 billion six-year computing deal with NVIDIA-backed startup Volta. It'll give them capacity at a Norway data center that's packed with NVIDIA's latest chips. The move underscores the soaring demand and the soaring costs of the AI race. The U.S. joined Japan in buying yen for the first time in decades. Analysts say that Washington's support may come with strings attached, including faster Japanese investment in America, trade concessions, higher defense spending, and pressure on the Bank of Japan to raise rates. And the U.S. and Iran may be nearing a deal to reopen the Strait of Hormuz. Treasury Secretary Scott Bessent says that an agreement could come soon, while Qatar confirms a draft proposal is circulating. President Trump is calling it Iran's last chance for a deal and says an agreement could come as soon as today.
This is a last chance for them to sign a good document. I think we're going to maybe get something, but I want to give them every last chance before decapitation. Very tough to do what we have planned, still planned. We'll see what happens.
Let's get the latest from Bloomberg White House correspondent Jeff Mason. Feel like we've heard that before, maybe not the decapitation line, but this is your last chance line. The negotiations that are going on with the Qataris, or what's been drafted, just how short term would this agreement be versus something that actually provides an off-ramp to peace?
Good question. I mean, number one, it looks like, and I think it's Oman that's maybe both Oman and Qatar are involved, but certainly Oman was one of the interlocutors. And I think it was the foreign minister or a spokesperson yesterday who said they're working on a short-term deal just to get back towards opening of the Strait of Hormuz and just bringing the two parties back into a mediation scenario. And there are questions about that because President Trump is saying that they're talking. Iran has said that they're not talking. The Omanis are saying that they're sort of in the middle.
Is there any chance that this president will agree to let Iran and or Oman charge tankers for going through the strait?
Well, he has said he won't, and yet that's exactly what those two countries apparently are working on. So that it's diametrically opposed to what President Trump has said. I mean, he even said yesterday, if anyone's going to charge a fee, it's going to be the United States. There's no real mechanism for the United States to do that unless the U.S. leaves forces in the region. And if he did that, then that would indicate a much, much longer conflict than I think the president had in mind.
What is the military position that the U.S. finds itself in right now? Because there had been reports of exhausting basically all munitions. How important is that fact in the background as all these negotiations are ongoing?
It's absolutely one of the factors. I mean, the president dismissed reports that was a big deal, but he, in the same breath, said, I wish we had more. And that's, again, for the president, I've covered President Trump a long time. And sometimes he'll say the quiet part out loud, which is his way of confirming something, even if he doesn't think it's a narrative that's in his interest. And I think in that case, that was the example of how he did that.
Another issue that's coming up at the White House today is there's a meeting with AI executives, maybe not CEO level, but below that, talking about China chips.
Yeah.
What's the what are they trying to accomplish?
So context here, this meeting is happening just a few weeks really now, or a month and a half or so before President Xi of China is coming to the White House, and that is absolutely a big issue between those two countries, which I don't need to tell you or our audience. They will be talking about security. The president had an executive order about AI not too long ago, which involved some voluntary agreements with regard to security, and that's an issue that they'll be discussing.
It does feel like this is, first of all, the CEOs of some of these companies can't agree whether they want open source, they want China involvement, they don't. But the direction that this White House is moving in, there was a Reuters report that they were looking at banning certain optic components in data centers that are made in China. Where does it seem like this White House is bouncing? Does it seem like some of their hawkishness on China trade will translate into them looking at banning various Chinese models or components?
It's hard to say. I mean, the president wants a really good relationship with President Xi, but he also wants to win in the AI battle, just like he wants to win in Iran and he wants to win in other areas. That's kind of his guiding light as a politician and as a businessman. So it's there are competing interests for him there as they make those decisions.
Where does he go from here in terms of issues? He's got the Iran war continuing to go on, no resolution on the AI stuff. That's going to go on.
Midterm primaries ongoing.
Well, the midterm's coming up, and that's kind of where I'm going. The Senate is going to leave town.
Yep.
With maybe a CR that the House will or will not approve. So when everybody comes back at the end of August, what are they going to be talking about? What's the president's going to do, if anything, to try to help Republicans through the midterms?
Yeah, well, he is traveling today and tomorrow. He's going to California and to Nevada, and he'll be talking about the economy and doing some fundraising. So I think that's a sign that he's moving, at least slowly, into midterm mode, keeping in mind that he was supposed to, initially, according to the White House, spend the entire spring touring the country and talking about the economy. That got jettisoned, those plans, because of the Iran war. But it's still on the agenda, certainly for the fall, because of those critical midterms. So I expect that we'll be hearing more from him about the economy, making that case. And yet the Iran war hangs over all of it, certainly because of the impact on oil prices and just the downward pressure that's putting on his approval ratings, which really matter when voters go to the polls.
Jeff, thank you so much for joining us again. Great to have you in studio. That's Bloomberg's Jeff Mason. Coming up on the show, Nimrit Kang joins us to explain why the AI conversation is shifting from CapEx to monetization. You're watching Bloomberg Open Interest. The stock market is hovering near record highs as earnings and AI optimism keep investors buying despite lingering macro uncertainty. Now investors are looking for proof that fundamentals can continue to justify those gains. Let's bring in Northstar Asset Management Chief Investment Officer Nimrit Kang. And Nimrit, you described this as a rotation, not a rollover. But I wonder, a rotation into what? Because as we hit all-time highs, or we look like we're about to today, it's Mag 7 that yet again is picking up the pieces and rallying.
Yeah, but we are seeing the equal weight index go all-time highs, And the other thing is this earnings season, almost 26% growth year on year in earnings. You separate out the non-AI companies, non-AI companies are growing their earnings by 17%. That's an acceleration from 14% in the last quarter. So this is becoming a broad-based theme in the market, Dani.
Well, broad-based is interesting because we saw Caterpillar today, huge results. And they're giving the credit to AI power generation sales. So how much broader can this get?
Well, for this, for the healthy market, it has to get broad-based. That's been the premise all along. A narrow group of companies can't continue to lead this market higher because, the rest of the corporate America that's spending on AI has to start to see those benefits come through in revenue growth, in margins. And we are seeing that. One of the things that we have seen, we monitor a lot of the industrial companies that sit outside the AI trade. Look at the rail companies. You are seeing a big rebound in growth year over year. So all of those things point to where there's a trickle down effect happening from just AI-centered expenditures into broad-based in other industries and sectors as well.
I'm so happy that Mike brought up Caterpillar, Nimrit, and your comments there, because it does feel indicative of a trend that we've been seeing. And you're pointing it out, more companies getting this trickle down from AI. I wonder, though, if there's just a risk within that. Let's take Caterpillar as an example. It was down 23% last month, its worst since January of 2009, because it was caught up in the AI sell-off trade. I wonder if there's a risk that it's a double-sided coin, that yes, it does well because of AI, but when AI sells off, all of a sudden way more things are correlated than you would usually think.
Absolutely. And we saw that in July. You know, you were easily able to spot all the companies that had gone up because of the AI trade, because they wrote it down on the other side too. And that's really where you figure out July was a great data point in helping us understand the benefits of diversification. It's almost like a seesaw we see happening in the market all the time. The companies that are very levered to AI, when they go up, they all go up. From Caterpillar to direct semiconductors to construction companies, all of them. And the other side is the companies that are not a direct derivative of the AI play. In July, we saw a bit of a rebound, capital flowing into some of those, what we would call the companies that have been left out of being directly supported by the AI build out.
Very quickly, before we have to take a break here, can you put a timetable on how long this can last in terms of when stuff is built, then all these ancillary companies aren't going to have the incoming revenue?
Yeah, that's hard. I mean, if you think about it, it started in 2022. It's now almost 4 years later that we're starting to see it get broad-based into the economy. That's a tough one, but we are just continuing to follow the earnings, and so far the hyperscalers are willing to invest.
Hey, Nimrit, stay with us. We have to pay our own bills and get through the opening bell. Nimrit Kang is sticking around. Let's get a quick check on markets ahead of that opening bell. And we are all set for a record high. The S&P future session is already there. The NASDAQ outperforms, up 1.2%, aided by Palantir's strong earnings and by 10-year yields, which are rallying. Yields come down 3.5 basis points. That, in turn, is because of oil. We have seen this correlation come back over the past week. Lower oil means higher markets. Brent crude currently at $80 a barrel after earlier this morning trading as high as 86. On the other side of this break, it's your opening bell. Seconds away from your opening bell, you're watching Bloomberg Open Interest. I'm Dani Burger alongside Mike McKee. Matt Miller still off on paternity leave. The S&P futures session reaches an all-time high. We closed just 0.1% away from an all-time high, so we only need a slight gain for the cash session to get there. The NASDAQ, that outperforms after Mag 7 posting its best day since March of this year. Dow Jones, that, if you care, also closed at a record high yesterday for your friends who still watch the Dow Jones. Ringing the opening bells, we have ADI. We have Rob Arness, the CEO, who joined our program just a few weeks ago. They've spun off from Residio. They're now their own independent company listed on the New York Stock Exchange. They do a lot of security, various devices and electronics. Freenome ringing the bell at the NASDAQ. They are an early cancer detection company. They are down this year by about 5% over the past 5 years, only up 10%. So they're happy, and they should be, but their stock has been underperforming. So that's a bummer for them. Outperformance this morning, though, from earnings. Palantir, look at these shares up 17%. It's something we keep seeing. These mega cap stocks report good earnings, and they swing like meme stocks. For Palantir, it was just a stellar set of results. That included strong enterprise sales that show AI spending is translating into meaningful revenue. We're going to want to see that from SpaceX, too. They're going to be delivering their first earnings report since they IPO'd. Shares are down 15% from that. The question will be not just growth, but what their margins and what their cash flow look like. Back with us is Northstar Chief Investment Officer Nimrit Kang. And Nimrit, a lot of the SpaceX question is as much about their earnings as it is supply. We're going to get a lockup where investors are able to sell more shares. How are you thinking about equity market supply with the various IPOs and events like SpaceX?
SpaceX is a unique asset, right? I mean, it's a tale of three different businesses. Their space business, their Starlink business, and of course the AI, which is where the big question mark is for the market and for us. And then, of course, you're hitting a wall of these lockup expirations that are going to happen over the whole year. So SpaceX will be interesting. I think it's too early. It's going to take several quarters to get a sense of where this business is headed and what's Musk's vision for the eventual final business. And of course, you have the technicals to navigate. So for us, we rather wait through the lockup expirations before thinking about a position there.
I just want to mention that I asked you before the break about how long some of this can go on in terms of the ancillary countries about companies in AI. Caterpillar's saying their backlog for diesel power equipment extends to 2028. So I guess we've got a couple of years to go there. But back to SpaceX for a second. Are they going to trade like an AI company? Or are they going to trade like a space company? Really, the revenue comes from Starlink, right?
Right. It's true, the revenue comes from Starlink. That's really the key marquee asset, which is very, very attractive given their positioning. But how the company is going to spend their cash flows and where they're going to need majority of the funds, that's the real question, right? XAI and what's the AI strategy, that's the real $100 million question for SpaceX, because that's driving how the stock's going to trade.
Nimrit, one of the tail risks that you flagged is what this bond market is doing. Today, yields are backing off as the price of oil starts to fall, but the 10-year yield at one point was at 4.73, currently at 4.63. Concern about inflation, what the Fed is going to do. It hasn't impacted stocks for now, maybe saved by earnings season, but as we work our way through earnings season, are you concerned that higher yields could eat away into some of the gains of this equity market?
Absolutely. Higher yields along with the slowing growth momentum is that toxic combination that we're on watch for. So far, as you said, earnings have kind of bailed out any kind of pullback and rise in the yields that we have seen. But that's something that we would be watching for. Every big bull market has been brought down by the rise in yields. But I think, Dani, it's also important to remember that this bond market and what we're seeing with the interest rates, it's this constant yo-yo situation we see based on the data points that are coming in. Just coming into this year, that was just 6 months ago. It feels like forever, but that's just, 7 months ago. We were looking for 2026 December Fed funds rate around 3%. So almost a cut, a cutting cycle from where we were. And now we're looking at 4%, so a hiking cycle. So things are changing very quickly as data is coming in and the bond market's evolving and responding to that as well. We also have new leadership at the Fed, and that's going to take a little bit of time. So we don't think it's actually, a flashing red sign at this moment, but it's something that we're definitely keeping our eyes out for.
It's an interesting point that you make, because this market's supposed to be a forward discounting operation, looking at revenues down the road. And yet every day it seems like we're up or down based on what the latest headline is. Have we decoupled from that long run and people are just sort of trying to ride this out right now?
The volatility has been really stupendous at this point. The single stock volatility is at all-time highs, magnified by leverage that we see, right? And leverage both on, and it works both on the upside and the downside. In some ways, we've seen pretty high retail participation, all-time highs on retail participation. And that's great because that does lead to democratization of investing, makes investing accessible for everyone, and it does lead to the wealth effect and the consumer spending that we're seeing. But the other side of that is we are seeing this heightened level of volatility that we didn't used to see 10 years ago, for example.
Nimrit, do you think some of the leverage has washed out of the system from situational awareness, that selling event that gets sold to Ken Griffin's Citadel, and data that suggests that some of the ETFs have turned to selling the more leveraged, risky ones that retail investors have been participating in?
It's hard to know. It's hard to know. The reason being, because if you come into the first 6 months of the year, semiconductor index up 76%. I mean, the fundamentals were great, are great, but they weren't getting better on the every daily, And on the downside, we've seen a drawdown. And yes, it's helped remove some of the leverage, or at least send warning signs to people who have a lot of leverage. But we think there's leverage in so many different places that it's going to be hard to just wash out in a single drawdown like that.
Nimrit, that's all we have time for, but great to get your thoughts this morning. Thank you for joining us. That's Northstar's Nimrit Kang. Let's get a check on your equity market right now, which is trading at an all-time high. If we can hang above here, just needed to get to 76.09. You can see that we are well above that. By the way, Bespoke points out that yesterday was the first time that we gained more than 1% for the first trading day of the month after this really long stretch of not being able to gain more than 1%. In fact, it was the longest stretch of seeing not more than 1% gains since 1996. Before this was a market that couldn't stop hitting all-time highs. Now we're only just getting back there. It's tech that's helping us this morning. Look at that chunky gain from Palantir, up 20%. That adds about 7 points to the S&P. Nvidia's having a good day, adding 12 points to the S&P. It's up for a total of 42 points at this moment. Caterpillar, Mike was talking about this, really strong earnings from them. Some of the banks doing well too. On the downside, you have Amazon, Exxon. There's going to be a lot of energy names in here just because the price of oil is moving lower. Apple slightly lower after trading at a new high watermark for its market cap. Some of the healthcare names not doing well too, so maybe that's more of a risk on trade. After we got some earnings from both Pfizer and Merck. Looking at the sector breakdown, again, it's energy that's going to be at the bottom, if not near the bottom. We'll see that in just a moment. There you go. It is at the bottom, down nearly 3%. Again, it's just because the price of oil is falling with optimism on an off-ramp to peace, or at least the Strait of Hormuz reopening. Real estate, utilities, staples. So again, it's the more safety stocks if you look at all the ones that are selling today. So it's kind of a very classic risk-on kind of day with infotech, materials, industrials, all of those doing well. Caterpillar is going to be sitting somewhere up in there for a gain of about 0.5% for an all-time high on a closing basis for your S&P. Coming up on the show, we're going to dive back into SpaceX earnings. Will it be enough to turn around the stock ahead of a flood of new share issues this week? We're going to discuss with Mandeep Singh. It's coming up next. Let's check in with the sell side and get some top calls. Here with that is Nora Melinda. Hey, Nora.
Hey, Dani. First up, looking at shares of Nike down after being cut to sell at JP Morgan. The firm's message is pretty simple. Nike's comeback is taking longer than expected, and it's going to weigh on sales and profits for a while. You're seeing shares of Nike down about 2.7%. Now over to retail. Walmart getting a downgraded Oppenheimer. The firm says the stock has had a great run, and there's just not as much upside from here. Analysts also point to some pressure in Walmart's pharmacy business. Shares of Walmart down about 1.7% this morning. And finally, we've been talking about it all morning. Palantir soaring for double digits, up about 21% and heading for its best day in more than a year. That's after another round of bullish calls from Wall Street following its earnings report. Analysts are saying that demand for its AI software keeps getting stronger, and they don't think the competition is catching up anytime soon. Those are your top calls. Dani?
Nora, thank you very much. We'll catch up with you in the next hour. Let's get more into the AI earnings. Bloomberg Intelligence head of global tech research, Mandeep Singh, joins us. We can talk about what we're expecting from SpaceX in a moment, but just picking up of where Nora ended on Palantir. I mean, revenue, U.S. commercial revenue climbing nearly 150%. It is so strong. Does it show that CEO Alex Karp has kind of convinced companies that should be your foray into AI, like set aside the large language models, use our products, we're more safe? Is that message working for them?
I think so. When it comes to the government contracts and, that particular customer base around defense use cases, they clearly have nailed it. This was their 13th consecutive quarter of accelerating top-line growth, so very impressive. But when a company is that sort of niche, you would expect growth rates to normalize. We haven't seen that with Palantir just because they have executed so well. But at the end of the day, it's a very high ASP product. They've got 1,000 customers with which now they're doing close to $8 billion in revenue. And that, to me, is the big risk, is once, your customers are maxed out, and they talk about open source, open weight models. If customers are using open weight models, why would they pay up so much for your product? And that's where the numbers look great right now. But my fear is they will normalize, and it's just a matter of when.
Well, Are they right that they have no real competition right now?
So they were one of the earliest ones to come up with this FDE concept, forward deployed engineers, and really customize the government work to get these products to execute to what the government contracts were looking for. And now they have expanded to every adjacent industry where the contracts are similar to what the governments do. But when it comes to LLMs, they didn't have any LLM play right from the get-go. They actually transition to, and they don't even train their own LLMs. They use OpenWeight or OpenAI and Anthropic. So that's where I feel like they're not a true LLM play, but obviously they have pivoted well and they are able to execute on that. And for me, the real question is, can they expand the customer base? And that they didn't answer last night.
So that's Palantir. We'll get SpaceX today. For this company, I just wonder if we're anything close to true price discovery. It's something we all talked about yesterday, too, the fact you're going to have this lockup, too. But does their earnings release, does that get us closer to understanding what this company should actually be trading at?
I mean, the multiples, when they are so rich, it IPO'd at 80 times, it still is probably the most expensive stock when you think about the overall tech complex. Yes, I expect them to post good news. The AI numbers would look good with the compute deals. But in the end, they have to lay out the 2-3 year out vision. And that's where the CapEx numbers are very important. More than the top line growth, I'm looking at what they are going to do in terms of their CapEx. Because we know, all the hyperscalers are close to $200 billion for next year, probably higher. What is SpaceX going to do? Because right now the consensus is more around $13 billion for AI. Are they going to raise that significantly to get closer to $100 billion? And that would be a confident sign that, okay, they actually believe the compute deals will translate into higher revenue and hopefully better margins. And that could be positive for the stock.
Well, do we get a real view yet on what this company is? You're talking about the capital spend on the AI side.
Yeah.
But they're a rocket company, they're a satellite company, they're a car company. How long till we figure out where it's all going to come together?
Yeah, so you're right. The sum of the parts framework is probably the best way to look at this company. And the satellite business, the Starlink business, should do very well. That's the cash cow. The space business, to me, it's too far out. Like, yes, we can talk about space data centers, but there's nothing imminent where I can model any revenues anytime soon. So if they want to show accelerating top-line growth for the next few quarters, then AI is your driver. And within AI, it's really the compute piece of it. Their own large language model, Grok model, isn't what is going to drive that AI revenue growth. It has to be that compute line. And we saw all the hyperscalers did really well this quarter, Microsoft, AWS. So to me, they are similar in that regard.
How much of it is something that other companies might emulate, like a Meta, wanting to basically fund all the spending they're doing through selling compute? Obviously, they don't have like a Starlink and a rocket business, but is there something to that business model? Should investors reward it today that perhaps, again, someone like a Meta could emulate?
I think so. I mean, Meta probably is headed that route where we would, I anticipate some announcement from them over the course of this year where they would get into compute rental business, because right now, every company needs more compute, especially the large language model providers like OpenAI and Anthropic. They're after a live compute, and that's what I think SpaceX did well during the time of IPO. So I expect
is there a trade-off, though, that you rent out your own compute? That means you're using less, so Grok isn't advancing maybe as much as the others. Is that a calculus they have to make?
I think there is a tacit acknowledgement already that our model is not being used. We hope, same for Meta as well. Meta and Grok, I think their models are not being used. They hope to continue to improve it, but for now they want to generate revenue out of all that compute that's sitting idle.
All right, Mandeep, thank you so much for joining us. I'm sure we'll catch up tomorrow after these earnings. Mandeep Singh from Bloomberg Intelligence. Coming up, another side of this trade, the data center boom. It's been fueling profit growth at Caterpillar. We'll break down their earnings next as the shares rally 9% in this morning's trade. You're watching Bloomberg Open Interest, 20 minutes into your trading day, and we trade at all-time highs, and we'll end there if we can close at this level. We just need to get above 46.09, well above there on the S&P. NASDAQ, that rallies 2%. The Dow Jones itself already trading at a record, another 1% if you care at all. Brent crude down 4.6%, so that's aiding this overall session as yields come in. A dollar little change. Maybe the yen is more interesting this morning. That was getting weaker as Treasury Secretary Scott Bessent was speaking. Nvidia, a good day for them. Palantir, an even better day after their earnings. McDonald's now flipping into gains after their U.S. sales disappointed. Spotify also reported earnings. Those shares just marginally down after that. And you can see their Caterpillar up 9.4% after reporting earnings that maybe reestablished that, yes, the AI infrastructure trade is alive and well. For more, we're joined by Bloomberg's Matthew Griffin on Caterpillar. I feel like it used to be this kind of like joking thing people would say at the beginning when Caterpillar was starting to enter sort of the AI power business, saying, oh, great, I guess Caterpillar is an AI company now. After this earnings season, can we definitively say, yes, Caterpillar is an AI company now?
Well, this will help clarify that narrative in investors' minds for sure. There had actually been some questions, of course, across Wall Street about the AI rally, AI infrastructure spending. Now you have this company reporting a record backlog, $72 billion at the end of the second quarter. They said on the earnings call they're getting orders for power equipment to power data centers out to 2030. I've been talking to investors this morning. They said that is calming a lot of the fear on Wall Street. Of course, they're also cautioning that a lot of this is driven by the macro, so nothing is certain about the AI trade. But right now, I mean, if you just look at this stock, it is clawing back a lot of those recent declines.
I was looking through the earnings report. It's not just the power generation. Construction's up big, and there seems to be an AI thread that runs through most of their divisions.
Yes, so the construction business sales there grew 35% year over year. That business, unlike power, had been in a bit of a downturn. Investors were waiting for it to pick up. And data centers are part of that story. You need construction equipment to build a data center. You also use a lot of copper. That flows to their mining equipment business. And it also helps, of course, it's also linked to the AI boom, so maybe some risk there. But the stronger that unit is, the stronger the ground this stock is on, because the more drivers it has if ever demand does falter for the power equipment.
I was just thinking, you know, heading into Caterpillar, we got ISMs yesterday, and some of the commentary, specifically around materials, has been really stark. Someone said no normalcy in sight in the world of metals. It makes me yearn for the coronavirus pandemic chaos, which was more manageable than whatever this is that we are in now. And I just wonder, some of that angst over metals and materials, how that factors into Caterpillar's business right now.
It is helping them directly. They actually just said on the call that demand for metals like copper is helping the mining equipment business. Sales there were up 20% in the quarter. That one investors have kind of seen as the laggard, the last one to pick up. And the tighter the metal market remains, yes, a big problem for other companies, but it's a direct benefit to Caterpillar.
Department of Footnotes. Some of the profit update came from tariff refunds, which is obviously something that is not going to continue. And now we're going to have new tariffs. How do they portray that within their outlook?
Yes, so Caterpillar tweaked its outlook for tariff costs a little bit down. They saw 2.2 to 2.4 billion in expenses this year. Now 2.2 billion. That is, of course, a big number. Some of that being refunded now, 392 million in the most recent quarter. So again, big number, but investors think the company is managing it very well, and they're starting to lap some of the tariff headwinds. So they're the same as they were a year ago, and that helps these growth numbers look good now that the company's kind of figured that out.
Anything to be upset with here? It sounds pretty good and straightforward across the board.
The tariff thing was called out as sort of a low quality element of the beat, but it didn't contribute, you know, everything to that beat. That's less than $1 of benefit, and they beat on adjusted earnings per share by $2 full. Another thing an analyst said is backlog was really strong. Some investors might have had even higher expectations, but from the way the stock is reacting, it seems like most of them were met.
Up 7.5% there, or abouts, trading at its biggest gain since April. Matthew, thank you so much for joining. Bloomberg's Matthew Griffin. Coming up in hour 2 of Open Interest, Indrani Day of FTSE Russell on her macro outlook, plus Goldman's chief credit strategist Amanda Lynam. And we're going to talk to an early SpaceX executive, Jim Cantrell, ahead of SpaceX earnings, and Bob Sloan, S3 Partners, talks tech shorts. All of that to come. This is Bloomberg Open Interest. 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Burger alongside Michael McKee, and we are now more than 0.5% above the last all-time high closing price, which happened on June 2nd. It's also helped out this morning by Brent crude falling below $80 a barrel for the first time since mid-July on hopes that we have something of an off-ramp to peace. We are just awaiting now different data points coming in. We have JOLTS, we have factory orders and durable goods. Mike, what are you looking at?
Well, let's look at JOLTS first because everybody wants to know about the employment market. 7,359,000 job openings in the month of June. That is down from 7,594,000. But I'm not sure how much difference that actually makes overall. The quits level is at 3,232,000, and the quits rate rises to 2% from 1.9%. That's kind of the one that people look at more because it gives you some idea of what consumer confidence is in being able to get a new job. So a tick up is a little bit of good news. Factory orders also in. This is, for the large measure, an update, basically, of durable goods orders. Down 0.3%. The initial report last month down 1.1%. Durable goods orders, as part of this, though, were stronger, up 0.5%. From a 0.3 in the month of May. And I think what we're seeing here is AI trade again. We saw that earlier today with the trade numbers as exports don't match up with imports. Imports as people bring in more stuff to use. Just mentioned that capital goods orders, non-defense ex-air, stronger. 1.2% from 0.9%. That's the part that goes into GDP. So we watch that as a proxy for business spending. But again, this was June data. Right. So it's already passed in terms of GDP.
Well, I love that you say that at JOLTS. You say what the JOLTS are, and then it's like, if, you know, because people apparently still care about this. Isn't this a data point that's really volatile and just means less for this market, or at least has less correlation, especially because it's June, what we're going to get to the rest of this week with like ADP, Challenger, and payrolls?
Yeah, it's not going to tell you a whole lot. Fewer job openings would, in theory, mean that there are going to be fewer people hired, but we still have enough job openings, way more than needed to fulfill the, to get to the neutral employment rate. So I don't think you're going to see a lot of people relying on this, but picks up tomorrow with ADP and ISM services.
Again, so happy to have you here this week, Mike. Joining Mike and myself around the desk now is Indrani Day, head of global investment research at FTSE Russell. Great to see you this morning. Thank you for joining as always. And as Mike points out, more of this data, be it the trade balance or durable goods orders, reflects an economy that continues to be powered by AI. All you need to also do is look at Caterpillar earnings, which were so strong because of AI. Do you worry about concentration in this overall market? Yes, we're hitting all-time highs. Yes, earnings are really strong, but just so much of that is underpinned by AI spend.
So I think it's a very interesting dichotomy that in one sense there is concentration of the theme that AI is becoming so important. And I almost like to say that we are in the midst of, we had the Industrial Revolution, we had the Internet Revolution, and we are possibly on the, verge of something very, very different world. But the broadening out in terms of the number of names that are benefiting from the AI theme, that's actually diversifying, which is one reason why you are seeing the small cap rally, why you are seeing the Russell 2000 have such a good year over the large cap. It's because there's a broadening out of the AI theme. More and more companies, it's not just the large chip makers, it's now the small companies that are helping out in the AI built out, that are, giving the inputs into the chip makers, the testing, or the network connectivity to the data center, that broadening out of the theme. And because there's such a need for demand for CapEx, there's such a need for capital, that's why you're seeing the banks doing well. And even everything going on in the Middle East, I would like to point out the US is an energy exporter today. So it is benefiting from the energy prices. So you are seeing that distinct benefit across technology, industrials, materials, all these kind of things. And that is one very important reason there's broadening out and why the small cap rally that we have been seeing.
It almost seems like this is the start of a new cycle in a sense, because what they always look for at the beginning of a cycle is small caps doing really well, and they've joined the party now.
Exactly. So this tailwinds to this broadening out and the small cap rally possibly has much more to go. However, one thing that I would point out is we are in the midst of higher inflation and higher rates and higher volatility. And what is important for equity markets today is the linkage between rates, volatility, and equities have gone up because there is so much capex. We have gone into a situation where the hyperscalers have gone from massive positive free cash flow to zero or negative free cash flow margin. That increase for capex and capital needs increases the linkage between what's happening on the rates front, rates volatility, and equity markets.
I think that is so interesting because already these were high duration companies because all of it that you cared about was their future cash flow. Now you have to discount that even more, and because they're infrastructure companies that start to see some of their various assets devalue more rapidly. So what does that mean at the very moment that we stand in where 10-year yields, yes, they've come down, but they're still at 4.6? Like, when do the warning signs start flashing that, yes, higher rates are going to become more of a headache for this equity market?
So I think it's kind of important to point out that higher rates, it's always a question of what is expected and what's actually happening. And what is interesting is we are in a world where both market participants and policymakers are ready for a world of higher rates. And why do I say that? I don't just look at the short-term rates market and what's happening, but if you see what's the terminal rate for the federal funds that's expected, both the median and the lower end of the range of terminal rate, US equilibrium policy rates, has distinctly gone up in the last year, 6 months, and things like that. And similarly, markets' expectation over the Fed funds future rate, the implied Fed funds rate, has gone up. So both market participants and policymakers are actually prepared for a world of higher rates. So to some extent, it's kind of built into expectation. However, the path can be much more volatile, because if you look at how much inflation expectations have come down since April, if you look at the inflation swap market, markets are pricing in inflation of just around 2 percentage points. And I would argue that sticky inflation is pretty high. Most actual inflation rates coming in at closer to 3%. So that disconnect between inflation expectations and actual inflation can cause much more of the rates volatility. And increasingly, in a world where the players of the AI, the beneficiaries, are broadening out into the small cap, the Russell 2000, particularly the growth segment of Russell 2000. These are newer companies. They are earlier in their stage, so to say. So the extent of pricing volatility as any new information comes in, that tends to become a little more volatile simply because they are newer, earlier stage companies. So we should be prepared for a world of higher rates volatility and higher actual equity volatility.
What about the rest of the market? And by that, I mean the consumer-facing side of the market, because we saw McDonald's today come in weak. Is there concern that that side of the market isn't going to be able to keep up now?
You know, that's a very interesting question. By a lot of indicators, the consumer, the average consumer, the lower end consumer, they are under stress. There is no doubt about that. But there is a strange disconnect there where most of the consumption in the United States is driven by the top 10%. And actually, it's not even the top 10%. It's really the higher end, the top 5 and the 2 percentage points. So in that sense, there is a disconnect where most of the consumption is coming from wealth and the higher end consumer. So the stress that you see in the lower end consumer tends to not get reflected in the headline GDP numbers and the headline equity return numbers. So there is that little bit of disconnect in inherently how the US economy has transformed over time.
Indrani, always such a pleasure to have you on. Thank you so much for joining.
Thank you.
Indrani Day of FTSE Russell. And a check on your equity market that is trading at all-time highs for the S&P 500 at 76.68. Just want to note that the NASDAQ still has a ways to go before it gets there. It needs to trade above 30,000 in order to be at an all-time high. Again, the Dow was already there yesterday, if you even follow the Dow. 10-year yields, those are coming in. Again, and Johnny was just talking about this phenomenon where we're seeing these companies that were already so linked to what yields were doing because they're longer duration, aka tech, now become even more so. So yields come down, you see equities rally, and that is because of Brent crude. Brent crude back below $80 a barrel for the first time since mid-July. That's trading at $79.82. Let's look at some of the movers on our radar this morning. With that is Nora. Good morning, Nora.
Good morning. 3 stocks on the move for you. Palantir, let's kick things off there, up 23% and on track for its best day in a year and a half. Now, that's after the company raised both its revenue and its profit outlooks. The CEO, Alex Karp, calling demand for the company's AI software, quote, otherworldly. So safe to say investors like that. Now over to heavy machinery, or maybe shall we call it AI? Caterpillar crushing second quarter expectations and beating on both profit and revenue. You are seeing shares up about 6%. Turns out that the company is also benefiting from the AI boom too, but strong demand for the power equipment helping run data centers. We are seeing shares, of course, to the upside. And finally, McDonald's posting slower growth for the second quarter in a row. The company says customers are still watching their pockets, so it's leaning into value meals to keep customers coming in. Think an Egg McMuffin, coffee, a hash brown. Guys, be honest, you're definitely craving a hash brown right now, I'm sure. We are seeing shares up about 1.4% right now, though. Those are your morning movers. Dani?
Nora, thank you very much. Always making us hungry with these, Nora Linda. We'll catch up with you in about 20 minutes' time. Coming up first, Goldman Sachs Chief Credit Strategist Amanda Lynam just joins to the show to discuss AI risk in debt markets. That's coming up next. This is Bloomberg Open Interest. Let's get you some high interest stories. A look at what's making headlines around the world. And the most read story on the terminal today, or one of the most, the rats may finally be on the run. Horrible video. I'm so sorry you have to look at this. New York City says that its war on rats is showing results. Report sightings are down 22% through July. Actually, it's kind of cute. I take that back. That's the fewest since the pandemic. Officials credit sealed trash containers that keep rodents from feeding. However, some neighborhoods are still seeing spikes, and experts say that more data is needed. Away from the world of rats into banking, Wells Fargo is launching tokenized deposits for commercial clients using blockchain to enable real-time cross-border payments. The program starts with U.S. dollar and British pound transactions and will expand next year. The bank says that clients won't need to change how they bank while gaining faster 24/7 payment capabilities. And JP Morgan is stepping up its AI push on Wall Street. The bank hired an NYU AI professor to join its new quantitative finance group, where the focus is using machine learning to improve electronic trading, from generating trading signals to executing trades. Elsewhere, loan investors are starting to push back as AI-related debt continues to grow. PIMCO President Christian Strack weighed here on Bloomberg Open Interest yesterday.
The beauty of AI is that it's disrupting technology and it's generating a lot of excitement through that disruption. Of course, the downside risk is that it's disrupting through its technology, and so you could see a lot of disruption risk down the road. So you don't want to have too much risk in any one project or in the whole complex. So that's something that we're very much keeping an eye on. It's a great opportunity, but you want to be moderate and measured in how you deploy into it.
Let's continue the conversation. Joining us now is Amanda Lynam, Goldman Sachs Chief Credit Strategist. It feels like everywhere you look, there is this conversation, concern about concentration risk happening, whether it's in private markets or public, which PIMCO, of course, looks at both of them, whether it be equity markets. And because of that, you are now starting to see some of the spreads widen, whether it be loans, whether it be CDS, on some of these AI-related companies. Is there real pushback happening in these markets? And if so, is that pushback warranted?
Well, good morning. Thank you for having me. I would say, yes, the concentration theme has come up in a few different facets in the credit market. One, as AI-related issuance broadly has accelerated in the credit market, investors are becoming more mindful about the various exposures they have, not just in their credit portfolios, but also in equities. And because credit investors don't share in the upside of our equity peers, we tend to pay more attention to the concentration risk. I think some of the pushback that you're seeing in other markets, I would separate that from the AI narrative, and a lot of that is just the software narrative, where some of these software refinancings are coming through the market. And keep in mind, many of these transactions were kind of struck in the 2021 era of very elevated valuations and very low rates. And so some of these capital structures just need to be right-sized. We tend to not pay a ton of attention to maturity walls across the credit market, but here in loans and in private credit, the 2028 maturity walls do matter. So we do expect to see more differentiation from the investor base as these different business models flow through, and it will really be up to investors to determine how much of this is right-sizing a capital structure and how much of it is actually parsing through potential business disruption risk from AI.
Well, is it pushing investors one way or another into different kinds of capital structures as they try to figure out which is going to be the safest and yet bring you the return?
I think for issuers that are looking for certainty of financing, customization, kind of a bespoke solution, the private markets are where they gravitate more. And I would say there's a lot of demand from investors in the private markets. By Preqin's estimates, there's $4.5 trillion of dry powder globally across all those strategies. So that's pretty meaningful. I think for solutions that fit more cleanly into a syndicated transaction, right now those markets are still a relatively low cost of capital. And so that's a good solution. I think what is most striking from our perspective is this kind of interplay across asset classes that we've sensed, because our view is that debt financing will play a larger role in this AI build out. So that openness and receptivity of the credit markets has become more relevant for equity investors. And our high level view is that we're not concerned about access to capital, but we just don't expect, for example, the U.S. IG bond market to do all the heavy lifting of the financing, and that it will be a more nuanced conversation across markets.
Well, you've talked about this, that, we have an overlap in borrowers in both syndicated credit and in direct lending. You're seeing them use both channels. One of the things you also point out with that especially in direct lending, I'm assuming this is what you're referring to, that the standard measures of credit risk have kind of changed. Well, what are the more important metrics to be looking at in this environment?
Sure, it's a great point. So a lot of investors will look at default activity and kind of missing the nuances under the surface that in private credit, we can have covenant defaults that aren't necessarily the case in the syndicated market. Really, the first default is a payment default. Those have very different outcomes. So for that reason, we focus more on realized losses in private credit. And then in terms of signposts to watch, we focus on things like non-accrual rates and payment in kind. So basically paying your debt with additional principal as opposed to cash interest. The high level view is that through the first quarter, so that's the most recent data that we have, we're seeing a modest uptick in non-accrual rates. And it's very consistent with the view that this is a market of dispersion, but not widespread market disruption. That will be key to watch. However, just like liquid credit, private credit is very growth sensitive. So right now, the growth backdrop is arguably good enough for credit. That will be key. And then beyond that, kind of this left tail that we're watching, both in liquid and private credit, of companies that aren't yet kind of growing into their capital structures even a couple of years after the pandemic now. That will be, I think, where we would be most focused in potential signs of stress.
How sanguine are investors about interest rates, which is a nice way of saying, does the Fed matter at this point?
It does. It absolutely matters. I would say for credit, it's a bit of an inverse reaction in that higher yields actually deploy a lot of our investor base into the market because they're incentivized to capture these all-in yields. I would say, though, the speed and the drivers of the rate moves are really what matter to our market. If rates are elevated because growth is holding in well, that is, and maybe there's optimism around productivity, around AI, that's a very different backdrop than if rates are rising because inflation expectations are becoming unanchored, which is not the view by many market participants that we speak to. So I think for now, it's been a backdrop that's very manageable. What our equity colleagues have also noted alongside us, however, is that the speed of that rate backdrop really matters. And so if rates are selling off in a disorderly way, that confidence of that yield-based investor really diminishes to deploy in our market. And so that tailwind doesn't work as well.
If we don't get cuts, though, and maybe we even get hikes, how much of an issue is that for the direct lending universe when already they're facing this backlog of private equity action, part of it maybe some can kicking, and I guess across the whole industry, how much has there just been can kicking, waiting for a more rate-friendly environment?
Right. So a hike, while not the base case of our economists, would certainly be an unwelcome development for floating rate borrowers that are already managing through higher cost inputs from higher commodities, the software potential overhang that we mentioned earlier. So wouldn't be a welcome development. In terms of how have markets kind of managed through this environment, we've seen a lot of amend and extend activity, even in commercial real estate, parts of the credit market. I think the distinction as this moves forward is, are you a good business model bridging to the other side of a potentially temporarily stretched balance sheet, or are you just a business model that will not grow into your capital structure? It's not a viable business model. So I would say, again, going back to this point on dispersion but not widespread disruption, it hasn't been a material headwind to the market, nor do we expect it to be. But I do think for these companies that were kind of lagging in an environment of above trend growth and low rates, it's just another headwind that they need to contend with.
Well, is there a time frame for when you've got to write those people off? And they always say that bad loans are made at good times. Is there something to worry about here?
Right. So the 2028 maturity walls are very key here, especially for the leveraged loan and private credit market, because they do have some heavy software concentration. On the bright side, we've actually seen some of these amend and extend activities go fairly well in that sector. But I do think as we get closer to that maturity wall, there will need to be some more nuanced conversations around what is the viability of the business model and can it really grow into its capital structure. But for now, I would say the market is still taking its time in evaluating those credit stories.
All right, Amanda, so great to have you on. Thank you for joining us, Amanda Lynam of Goldman Sachs. Still ahead, we look forward to SpaceX earnings. Joining us will be Phantom Space CEO Jim Cantrell, one of the early employees at SpaceX. This is Bloomberg Open Interest. Just about under an hour into your trading day, and we're still at all-time highs. If we hold at this level, we'll close well above them, about 0.5% over the all-time high we hit in June 2nd. NASDAQ isn't there, but it is rallying, outperforming up 2%. The Russell 2000, a good run too. The Dow also at a record. All of that is really being helped not just by earnings, we'll get to that in a moment, but what's happening in the macro landscape. Brent crude falling as optimism that Oman and Qatar have reached something of a temporary peace agreement that will allow the Strait to be reopened. So Brent crude below $80 a barrel for the first time since mid-July. 10-year yields down 4 basis points. So the rest of this board, a lot of it is really good earnings. Good earnings from Palantir, up 25%. Solid earnings from Caterpillar. McDonald's, actually not very strong earnings, but those kind of flipped. They're getting a new head of the U.S., and the U.S. is where the weak spot was. Kimberly-Clark up 1%, but they trimmed their annual growth forecast. SpaceX, we're awaiting that. We're going to get earnings after the bell, and coming up, we're going to talk more about it. Phantom Space CEO Jim Cantrell on what the overall space universe is looking at as we get this report. Again, we're also going to have a lockup period, which means more selling of SpaceX shares shortly after this earnings result. So a lot to watch out for. We'll cover all of that for you on the other side of this break. You're watching Bloomberg Open Interest. SpaceX is set to report its first earnings after the bell, with investors watching AI spending, Starship, and launch demand. Joining us now is Jim Cantrell, CEO of Phantom Space, a startup that builds launch vehicles and space infrastructure. Jim, can I just get the take from you? What's at stake for the entirety of your industry through these SpaceX earnings?
Yeah, I mean, SpaceX is really sort of the leading indicator of the value of the space industry as it goes into the future. So a lot of our fortunes are for better or for worse, tied to how well SpaceX does. So we all hope that they do very well.
One of the things that people are watching is who survives in this industry. What's your niche, and how are you trying to fill that compared to some of the competitors you have? Multiple launch companies out there.
Yeah, so we're building for terrestrial analogies. We're building the roads and the infrastructure in space so that the next SpaceXs can thrive. So we're building the launch vehicles, we're building the satellites and the data capabilities for the next generation of SpaceXs.
I just wonder, with all of this, investor willingness to continue to fund it. And Jim, you've been through these trials and understand this better than anyone. You, of course, had Vector launch, which at the end of the day failed to continue to get financing, and that made it difficult to just exist. We are starting to see in bond markets, for example, SpaceX debt has been trading below par for some time. The shares of it itself has started to fall. Are you noticing any investor sort of pushback that might echo past times around just the amount of capital this takes and the amount of cash burn we typically see in this industry?
Yeah, for the last 25 years since we started SpaceX back then, investor capital is always scarce, especially for more risky kinds of ventures as space. And so there's always pushback on how much capital is needed to do these things. And if you look at the companies that have succeeded, they've all done it very capital light, including SpaceX. In the early days, they got their first rocket up for $100 million. At Phantom, we're on par to match that kind of performance. So the ones like even Richard Branson's Virgin Orbit, they raised billions of dollars and went under. So there's always that issue. And you find that these markets are cyclical, that they go into a hype cycle and then they go into this deep down cycle. So where are we today? Who knows, right? There's so many macro elements that affect that. But space is here to stay, and it's a long-term positive investment. It's like North America was 500 years ago. This is the new frontier, and it's going to have its ups and downs.
Well, what are you going to do to survive and to continue attracting capital?
Yeah, at Phantom Space, we're extremely frugal. We have very low burn. We have very experienced people that have done this before. And as like we say, this is not our first rodeo. So we know what not to do and what to do. And we focus on profitability at Phantom. We focus on making a vehicle, for example, our Daytona, that actually creates a strong profit, and contracts that generate the revenue. And so we've got some pretty big names lined up to announce later this year on some big contracts. And NASA just upped our contract with them at Vader for $1 billion for launch services. So, if you can perform and create value, then you'll be fine.
How, as you look forward again, do you see competition in this space? Because SpaceX, obviously, especially post its IPO, got many excited. There are other competitors in this space, a lot of VCs funding various space companies. What does competition look like, Jim?
So SpaceX is truly not a competitor to anybody else. They're almost like a nation state. As they've evolved, they resemble, a lot of countries that have their own launch capabilities, their own satellites, their own communication systems. So truly, they don't compete with anybody else. And in the end of the day, they're looking at planetary settlement, which nobody else is doing, not even nation states. So the rest of us are filling in behind SpaceX to essentially what they're leaving behind, which is this entire space economy that SpaceX grew, that is now underserved as SpaceX goes on to use launch more and more for their own internal purposes. So there's room enough in this business in the United States, for example, for 5 other launch companies, and there's about that many that survived the last nuclear winter and launch, and they'll go forward and be profitable if they execute.
All right, Jim, thank you so much for your time this morning. We appreciate it. Jim Cantrell of Phantom Space. Let's get a check on your equity markets, an hour and some change into your cash equity trading day. And again, another all-time high. So what we needed to hit was 76.09. We're trading at 76.74. So we're well on our way to close at all-time highs. We are up 1%. The NASDAQ, that outperforms. It had been lagging, but we start to play catch-up. The Mag 7 had its largest daily gain yesterday since March 31. We're also on pace for the S&P to have its best start to the month since the first trading day of October 2022. So this rebound starting to stack up a lot of superlatives for this market. The other superlative is that Brent crude was trading under $80 a barrel. That was its first time since doing that since July 31st. It started mid-July, rather. It's backed off of that. We're still down a solid amount, down 4%, but we're basically right at the $80 mark. More optimism that some sort of agreement or some sort of plan will be put forward by the Omanis, the Qataris, that will allow for a short-term agreement that gets the Strait of Hormuz reopened. Meanwhile, your 10-year yields, those come into down by about 3.5 basis points at 464.10. Let's look at some of the other movers on our radar this morning. With that is Nora. Good morning, Nora.
Hey, Dani, let's kick things off with onsemi. Flipping between gains and losses, now up about 0.1%. The company beat on both revenue and earnings. Guys, the story has not changed. AI data center demand is still doing the heavy lifting, and analysts say that's what is driving results here. Now, sticking with tech, remember Snapchat, the company posting a sales beat and an upbeat forecast? But here's something maybe you didn't know. The company's betting on what's next. Its first pair of augmented reality glasses launching in September. The CEO calling it the company's biggest long-term opportunity. You are seeing shares of Snap up about 13%. And finally, it's been a roller coaster ride for SpaceX since its blockbuster IPO in June. Now Wall Street is watching as the company gets ready to report earnings for the very first time as a public company after today's closing bell. You're seeing shares of SpaceX up about 3% right now as we speak. Those are your morning movers. Dani?
I think everyone knows Snap is trying to get into augmented reality after that spectacular, horrible launch of those glasses where poor Evan's ear was folding in. That looked really heavy. Nora, thank you so much. Appreciate it. Coming up, we're going to have more on SpaceX's earnings after the bell, but from a different angle. We're going to look at short positions with Bob Sloan, S3 Partners founder and managing partner. Looking forward to that conversation just on the other side of this break. This is Bloomberg Open Interest. Short sellers are piling into SpaceX ahead of its first earnings report after the bell. S3 Partners reporting that the bearish position is now worth $24.6 billion. That exceeds the value of short bets against Tesla, another major public company led by Elon Musk. Here to explain is Bob Sloan, S3 Partners founder and managing partner. Bob, great to see you.
Always great to be here. Thank you.
In the early days of Tesla, in the first 4 days after IPO, it gained 50%. And I remember there was this conversation of why would you short this thing? Because it is having this spectacular rise and maybe it could be really painful. Just how much has that conversation flipped now?
Well, zero is the biggest number in business, right? So if you're not losing money, short sellers will leave the scene. But the dream of SpaceX is really an American dream. It really is. I mean, you think about it like zero gravity FDA tests, no energy data centers. I mean, it's an amazing thing. If you think about the budget of SpaceX, what government agency actually has more money to spend? Like the Pentagon? This is a massive thing. It actually is government work that has been privatized. So the bet is, once again, just like Tesla, they will run out of money before all these dreams come true. That's what's happening.
But is it a quarter-by-quarter thing? I mean, we don't know what they're going to announce. We don't know what they're going to say. We just know that they've given us the idea that profitability is way out there. So how do you put a time frame on that?
You don't. I don't think this is a quarter-by-quarter story. It's a multi-year, maybe even multi-decade story that has $100 billion to spend. That's a lot of money. Now, short sellers have piled into this trade because it is the frothiest trade that there's been. There's never been a trade like this where you have no earnings, you have the ability to actually execute on SpaceX and Starlink and all these different things. But they don't have any competition either. Like, what is Amazon doing in this space? Not a lot, right? So the short sellers are just saying, this is just overdone. We're going to make a big bet. And it's worked because they're up about $8 billion.
Bob, we have a viewer writing in who wants to know just how much is hedged with those early investors locking up, considering we're getting more supply coming to this market this week.
Well, the question is how much of that early supply gets unlocked. And that's unclear, right? So like Ron Barron's on record as saying, I'm not going to sell. And a lot of other people doing the same thing. So I think measuring that overhang is very tricky, right? But like some of the other tech names, there is hedging against the debt that they issued, and that's part of it. But overwhelmingly, this is a directional bet.
What is it going to take to move the stock at this point?
So we think that the average stock price that short sellers actually initiated the position is $150. I think this morning was at $118, I think the last time I looked. So you'd have to have something pretty big to move that security 20% to go break even. So the number one rule is if short sellers are making money, they're not going to cave in their positions. They're going to hang in there because it's working.
What about like a Tesla merger?
That would do it. That would do it.
The drop-off in Tesla shorts, do you think some of it might be because of this expected merger? Have people backed off of their bearish positioning?
It's a great point because one of the things that we mentioned in our report is that the amount of shorting in just as a percentage of float, also in nominal terms, is larger than Tesla. It's actually, as a percentage of float, the largest in the Mag 7. Not as large in nominal terms as Nvidia, but yeah, it's a massive position. It's only 60 days old, not even. Mm-hmm. So over a very, very short period of time, you've seen this massive buildup in the position. And that's, I think, people understand the transference of wealth that happened between retail and the institutional investor, and they're shorting into that.
Speaking of the institutional investor, the thing that seemed to be dominating the market narrative last week, and maybe for longer than we realized, was situational awareness. Yeah. The hedge fund run by the 24-year-old that had to unwind, got margin called. Ken Griffin comes to save the day. Yeah. I know that you've been looking through some of the positioning, and I wonder with hindsight, if there was an element of people looking at this fund, saying something is going on here, and starting to short the stocks that he owned, and if that exacerbated some of the market sell-off we saw in the recent month.
You know, he wrote a letter saying basically, I don't know exactly how he phrased it, but he was like, there's predatory trading or there's aggressive trading. He didn't come out and say short selling, but that's what he meant. Let's be clear. You have super concentrated positions and super crowded positions that are super levered, that are super volatile. Wow, nothing can go wrong there. You know, I mean, it was like a poster child for just froth. And he got caught up in the middle of it. And you can see that actually a lot of the names that he was long have convertible bonds associated with it. So 30 to 40% of the shorting in those names were actually hedging on converts. They were actually playing volatility. They weren't actually saying, we hate this company. They were just playing the volatility in the stock. And obviously, a lot of those stocks are very volatile, so it was a profitable trade. In the neo-cloud space, that is where things turn bearish. So IREN, CoreWeave, et cetera, those holdings actually, you saw those convert positions cover their short and actually go directionally short against the companies.
Now, on Thursday, we get the end of the lockup, and there are predictions that a lot of people are going to want to try to make some money, but the stock's way down.
Yeah.
What are you expecting on that? And there is also a theory that the shorts are going to have to buy the stocks back at some point, so that's going to raise the price for a lot of these people.
The question is at what price, right? And so, sure, that's the great thing about shorting is that there is a buyback mechanism embedded into the product, into the strategy. But when that'll happen, that is so idiosyncratic and dependent upon each portfolio, it's almost impossible to predict.
So for now, as we await what SpaceX brings us and what the reaction will be, we're starting to see this rebound overall in markets. And I wonder if there is something of a positioning watch out, post-situational awareness, post some of the leveraged ETFs, and what you're seeing, whether it does suggest maybe we've kind of backed off the most extreme positioning that we were on before.
So we've been watching the hedge fund long positions and also active long positions in a different market because we think there's a parallel to what we're going through right now, which is the Kospi versus Hong Kong, the Hang Seng Index. And so before, about a month ago, you saw longs in the Kospi in South Korea, which is basically dominated by two stocks, Samsung and Hynix, obviously, memory chip dominated. You just saw longs accelerating at a massively faster rate than short positions. And you saw the exact opposite happening in Hong Kong. You saw short positions accelerating massively faster than long. Now you've had them cross. You see that the long positions in Hong Kong are actually accelerating way faster than short positions and the vice versa in South Korea. So it's actually, these spreads have actually crossed one another. You could see the similar type of thing. So in other words, a big rotation from where we are today to something else.
Well, to go back to Dani's question, are we losing the froth now and not any, to mix metaphors, muscle?
If the S&P makes $400 and you put a 20 multiple to that, that's 8,000. Does that sound crazy to anybody? I don't think so.
So I think that some of the more like bullish estimates on this S&P are like way above that anyway.
Exactly. So I just think 20 times $400, companies are making money. Let it ride.
Yeah, earnings are strong, the best out of a non-recessionary period. Bob, so great to have you on. Thank you so much for joining. Enjoy the rest of your week. That's Bob Sloan, S3 Partners. Coming up, AI volatility. As Bob was just discussing, it has been rattling hedge funds. We now have the returns data in hand. We speak with Hema Parmar coming up after this break. This is Open Interest. The AI sell-off is creating winners and losers across Wall Street. Former Citadel portfolio managers at Fifth Delta gained nearly 9% last month, while Coatue posted its worst monthly loss in more than a year. Let's get the latest from Bloomberg hedge fund reporter Hema Parmar. Hema, we can get into the individual funds in just a second, but was there an overriding theme as to which funds succeeded and which did not?
Yes. If you had significant AI exposure, you were in a great deal of pain this month and last month. So we are seeing that with Coatue. We expect to see more numbers coming out throughout the rest of this week, and we may see some more pain in these equity-focused funds that care a lot about AI.
But now does it matter in the sense that it's all turned around for all of these Magnificent Seven companies. So if you're Coach, you can say to your investors, wait till you get this month's results.
This is true, exactly. So, this is a volatile industry. When you look at funds who trade AI stocks, these equity funds, we did see a rally after Citadel came in to save situational awareness. So we may see better performance coming out this month. You also may see funds buying up AI stocks, buying the dip. So we will be curious to see how funds do in August. But, this was a pretty bad month for a lot of funds who were trading the kind of volatility, and investors, for example, in Co2, they've been down 5%, they've been up 14% in another month this year. It's been something of a roller coaster. It's what you might expect from funds that focus on it. But yes, we may see a better month in the coming months.
So what was the deal over at Fifth Delta? What were they doing right?
Yeah, so they're up nearly 9%. Really the flip side here, they made money on short positions. So they were short semiconductor stocks, they were short industrial and automotive markets. So that's where they really made money, as a lot of those stocks were falling. They also made some money on certain long bets like cyclical industrials.
So the stocks that didn't, the funds that didn't do well, basically were trading volatility?
The funds that didn't do well were fairly concentrated. Co2, for example, just because they're the funds that we have those numbers, they are pretty poor, down 8%. So their four biggest positions were in AI-related companies. So Taiwan Semiconductor, GE Vernova, they're sizable positions, and they all fell. Some fell like almost 20%, even more. So when your biggest stocks really turn against you, it can be quite painful.
Do you think that this has also prompted investor conversations with the various fund managers about concentration risk, or do you think it's these firms? I'm guessing it's going to vary based on who they are, like a Citadel with a Ken Griffin who goes in and buys and says, well, if you liked how we were doing before, you're going to love these stocks even more now that they're cheaper.
Exactly. So, when we look at Citadel, a multi-strat fund, Millennium down 2%, a very different type of hedge fund than the long-short equities, a lot more complicated, a lot more risk management. They do a bunch of different types of investing. So when you look at Citadel, they actually had somewhat of a middling year so far. We will be curious to see how they do post this sweet deal to have bought up a lot of equity stocks at a discount. We expect that to be lifting their returns for the month as they do that. And obviously they don't have that same concentration risk because they trade across assets in teams that trade more individually. So it's a different type of hedge fund if we look at the model of the firm.
Some of the losses that they had, and then you have situational awareness.
Yeah.
Are people looking at that as a discrete event, or is there some concern? Let's look under the hood at some of these other funds.
That's a good question. I think in some ways it's a discrete event. In some ways it is the story we have seen time and time again about a fund that just takes far too much leverage, is too concentrated, makes these ginormous bets, raise a ton of money, and all of that working against, when the shorts work against you and the longs. The traditional hedge funds that we look at that manage the money of more institutional investors, because situational does more founder type of capital, those hedge funds tend to not take the same degree of leverage on a concentrated position. Like, we don't believe Co2 has 4 times leverage on their book of stocks. They also tend to do more hedging and tend to have more risk management. So we are still looking for pain across funds that do AI investing and have that focus and bullishness on the space. I don't think we expect the kind of declines that we've seen from situational in these other types of traditional hedge funds.
Hema, such fantastic reporting. Thank you so much for bringing it to us. That is Bloomberg's Hema Parmar. All right, as we head to the end of the hour, it's a market that continues to rally at all-time highs, up 1% for the S&P, 2.2% for the NASDAQ. Coming up on tomorrow's show, JP Morgan's Shad Jasmira Pandit, Sarah Ketterer of Causeway Capital, and the Booking CEO Glenn Fogel, plus Brookfield Asset Management CEO Connor Teskey, and the CFO of Carlyle after their earnings. This is Bloomberg Open Interest.